Welcome everyone to panel 7, the final panel of CARI's 2021 conference. My name is Yoon Park and I'll be serving as the moderator for today's session. The papers today covering the impacts of Chinese lending and development finance in African countries are presented by another 4 of this year's cohort of CARI's Research Fellows. All of the papers in this panel are based on empirical research and econometric analyses using CARI loan data and other data sets. Today, we'll hear about how funds are allocated within countries and their impacts on economic growth, local entrepreneurship, and global value chains. As in previous panels, I'll introduce the speakers and our discussant one at a time just before they speak. They will each have 12 minutes to present. Please note that if you have any questions, you can post these at any time during the session using the Q&A function. And please remember to briefly introduce yourself and specify to whom you are directing your question. 2 last remarks before I introduce our first speaker. One, it's still me, even if I no longer look like the photo on my headshot. This is the new COVID era look. And 2, please don't expect any clever or insightful comments from me after each of the presentations. As a sociologist, I will definitely stay in my own lane. For the brilliant commentary, we have a specialist serving as our discussant, and he can speak the language of econometrics and take up these tasks. With that, I'm very, very pleased to introduce our very first speaker, Ms. Keyi TANG, who I've had the pleasure of working with for nearly 4 years. Ms. Tang is a second-year PhD student at Johns Hopkins SAIS. She studies the political economy of development with a regional focus on Sub-Saharan Africa. Her work on impact evaluation of China finance hydropower infrastructure in Ghana was recently published in the Journal of Energy Policy. And she's also done research on policy diffusion of special economic zones in Ethiopia and Vietnam. She received her MA in International Studies from the Hopkins Nanjing Center and a BA in English Language and Literature from Nanjing University. Welcome, Keyi. On to you.
Thank you. Can I share my screen now, or we should wait a little while? Or awesome. Hi everyone, I'm Keyi, and today I'd like to share some of my very preliminary findings of very early stage research, and I really appreciate any comments. So the title is Development Finance and Distributive Politics, Comparing Chinese and World Bank Finance in Sub-Saharan Africa. I'll first do a brief introduction of the background of the research and some related literature. I'll introduce the data and the research design and the regression results and some of the qualitative case studies supporting that. And yeah, finally the conclusion. So a key puzzle driving this research is, where did the development finance go at the subnational level? So researchers have shown that the money doesn't always reach the people who need it the most. So previous research shows the factors from either the supply side, the foreign financiers, or the demand side, the recipient countries. So on the supply side, donors may influence the distribution of foreign finance because of the conditionality of foreign policy. So for example, World Bank has stringent conditionality on the disbursement of their loans. But China's finance is much more demand-driven because of China's non-interference foreign policy. Also, OECD donors tend to distribute their aid based on foreign policy alignment. However, on the demand side, researchers also show that within the recipient countries, rich and urban communities tend to receive much more money than the poor communities. Those ethnic or regional strongholds of the leaders tend to get more. and also among the democratic leaders, because they have a much larger winning coalitions, they tend to distribute it and aid in a much more fairly and inclusive way. So noting all these complex and mixed evidence factors influencing the foreign finance distribution, I consider it inappropriate to looking at only one side of the story. So I will examine how foreign financiers' conditionality and the regime types of the recipient countries both together. So my research questions is the World Bank's finance to more democratic regimes in Africa less likely to be captured by leaders for geographical targeting and political favoritism? How about China's finance? I focus on World Bank and China because they're the two biggest financiers of Africa's development projects, foreign finance, yes. To answer my questions, I employed 4 databases. In my large N regression analysis, I mostly use Exodraher and ADATA's data on the Chinese and the World Bank's finance to 48 African countries at the district level from 2000 to 2012. And to corroborate with my findings there, I use more recent data from SAIS CARI and World Bank project data, and I took a close-up of 2 country cases, Zambia, a hybrid region, and Ethiopia, an autocratic region, how they distributed Chinese and World Bank finance during their presidential election periods. And the last database is the Varieties of Democracy project data developed at the University of Gothenburg. So they measured level of democracy by taking the weighted average of a set of democracy-related indices and then aggregate at the country year level. So my key dependent variables here are the amount of finance each district from both China and World Bank in 48 African countries by year. I took the arc sign of the levels of the Chinese and World Bank foreign finance levels, flows, current aid flows. Most people did it using the logarithm, but given that some districts, they don't have any Chinese or World Bank's finance, you can risk a bias because logarithm of 0 is not defined. In my empirical design, I use 2 functions to answer my questions. The first main independent variable is the binary variable co-ethnic, which equals 1 if a district shows most of the population shows the same ethnic background with the leader, and 0 if not. So this function basically captures the ethnic favoritism of Chinese and World Bank's finance across all region types. And of course, there are gazillions of control variables. In my second functions, I measure the heterogeneous effects of ethnic favoritism of foreign finance across different region types by adding a categorical variable, region of the world, the ROW. So this is from the Variety of Democracy and has 4 categories: closed autocracy, electoral autocracy, electoral democracy, and liberal democracy. So this, by focusing on the interaction, I can see how in different region types, co-ethnic, whether being a co-ethnic will give you more amount of Chinese or World Bank aid finance. So this table shows part of the result of my function 1. And it basically tells you that both Chinese finance and World Bank finance cannot be free from ethnic favoritism. This shows that in comparison with a non-co-ethnic district, a co-ethnic district receives 106% more Chinese finance. And for the World Bank, it's 52% more. So World Bank's more stringent conditionality may help alleviate, but not eradicate ethnic favoritism. This table further shows that the ethnic favoritism increases as the level of democracy increases. So the close autocracy was omitted due to coloniality. So essentially here, we're comparing everything, electoral autocracy with, everything with closed autocracy. So for example, for the World Bank, if it's a ethnic district in a liberal democracy, it has 383% more, World Bank's finance than a closed autocracy. So I was thinking that this might be because in weak institutions, ethnic political competition may actually feed clientelism. So to better understand the relationship between political competition and ethnic favoritism, I decided to look closely on two cases. One is Zambia and another is Ethiopia. And given that presidential election is the period when the political competition reaches a peak in each country, I decided to focus on the two last elections in two countries. And I examined the subnational distribution of Chinese and the World Bank finance to the two countries right before, during, and right after their election. So essentially it's like 3 years to see whether there's vote buying behaviors, except for the Zambia's 2010 to 2011, because the incumbent party was kicked off and they can't buy vote after the election. So in Zambia, this figure shows Chinese annual finance to Zambia from 2002 to 2019, and the red line is the year of the election years. And we can see that the spikes of the annual Chinese total finance to Zambia is like closely aligned with the election year. And a closer examination of where did those money goes by province, it further shows that the incumbent Zambian parties distribute more Chinese finance to their ethno-linguistic strongholds. So for example, if you look at the dark bars, which shows that from 2010 to 2011, the election period there, when the MMD party is the incumbent, they substantially distribute more Chinese finance to the Western, Eastern, Northern, and Central provinces. So those provinces gave the MMD much more votes in the previous election. However, when things move on to 2014 and 2017, when they have two elections, 2015 and 16, when the Patriotic Frontier PF government is in power, they gave much more Chinese finance to the Copper Belt, Lusaka, Muchinka, and Luapula. In those provinces, the population are dominated by the Bomba and Ninja speaking people, and those people are the strongholds for the PF government. So Zambia's finance in World Bank finance in Zambia shows similar pattern with China's. The peak inflow years are less synchronized with the election year. However, as Zambia's election becomes increasingly competitive and the winning margin becomes increasingly smaller, the PF government substantially also distribute more World Bank's finance to their Bomba and Ninja speaking population. In contrast, in Ethiopia, which has been long de facto one-party state led by the EPRDF government until very recently. So the competition was very small, as in 2016, the EPRDF government even won the 100% of the seats of the entire National Congress. So there's very little competition there. And the EPRDF was dominated by one branch, which is from Tigray region, the Tigray People's Liberation Front. And we can see that the variation of annual Chinese and World Bank finance inflow does not show much alignment with election cycles. Also, the subnational allocation does not show clear signs that the core ethnic region, the Tigray region, receives substantially more development finance. And lastly, Most of the subnational allocation during election years are in areas defined by the EPRDF as your National Structure Transformation Plan. So in conclusion, my research finds that an increase in the region's level of democracy is positively correlated with an increase in the amount of Chinese and World Bank finance flowing to the co-ethnic regions of the region's leader. And although the magnitude of ethnic favoritism involved in the allocation of World Bank finance across all regions is less than that of China's finance, more stringent conditionality cannot prevent ethnic favoritism. To answer those observations, I propose that the competitive clientelism in many African countries may force leaders in multi-party politics to transfer more resources to their co-ethnic, while their autocratic counterparts only need to satisfy a small circle of elites. Thank you again, CARI, for funding these projects. That's all.
Thank you so much, Keyi, for keeping to time. Our next speaker is Vito Amendolagine. Before I introduce him, I just want to remind everyone that your questions can be posted at any time, but please use the Q&A function at the bottom of your screen, not the chat. Thank you. Vito is currently serving as assistant professor of economics at the University of Foggia in Italy. His research is focused on international trade and development economics, with particular attention to foreign direct investments in sub-Saharan African economies and technological investments in emerging markets. He's going to speak to us now on his research on international development lending and global value chains in Africa. Go ahead, Vito.
Thank you, Yoon. Good morning, everybody. I'm Vito Amendolagine from the University of Foggia, Italy, and I'm very happy to share with you today the results of my research work about international development, lending, and global value chain in Africa. First of all, I'd like just to mention what we mean by taking part in global value chains. So it means carrying out some particular stages of production processes developing in more than one country, and actually translates to international trade of intermediate goods. The literature has already highlighted the benefits coming from taking part in GVCs in terms of growth, in terms of poverty reduction. IMF defines GVCs as a golden opportunity for developing countries, since these countries often are struggle to build comparative advantages over the full value chains. Already, the literature has already also shown which are the factors that can boost GVC participation, which are related to technology, institutions, infrastructure, factor endowments, and credit market. However, there is no space so far for international lending, so the literature has not said anything yet about the potential role that international lending has for boosting participation in global value chains. So I feel this gap with the literature with an econometric exercise over a novel data set, which collects information from different sources, starting from the CARI loan data set. I take all the loans from this data set, the Chinese loans directed to Africa from 2000 to 2018. And also I exploit information about the value, about the sector, year, type of finance, and lender for each loan. Then I take similar information for World Bank loans. World Bank is used as an example of a relevant example of Western multilateral lender. And GVC indicators are built using UNCTAD EURA Global Value Chain database. Plus, I use also information from one PEN World Table and one other World Bank indicators. So cleaning off all the missing and unreliable information, I end up with a country year level data set covering 35 African countries observed from 2000 to 2018. Here are two maps which show the major destinations of Chinese and World Bank loans. We see that for both the lenders, Ethiopia, Egypt, Nigeria, Kenya, and South Africa are very important destinations. For China, further important targets are Angola, Zambia, Cameroon, and Congo. Interestingly, the two lenders have, China and World Bank are quite different in terms of sectoral, say, destinations. Particularly, China targets infrastructures for 60% around of the loans, and 36% particularly goes to transport and communication. While World Bank, for World Bank, very important targets are social sectors, meaning government, health, education, and environment. So as I said, I carry out an econometric exercise, and on the data set which I have just described. So I run panel regressions which estimate the effect of Chinese and World Bank lending on the growth rates of two indicators, which are GVC participation and GVC position, observed up to 4 years after the loan. Okay, so to build up these two indicators, I exploited the decomposition of value added in gross exports, which in the theory is present in Koopman et al. In 2011 and 2014 papers. So basically, for each borrowing country, okay, we decompose the gross exports into different components, and this decomposition allows to identify the components, the two components in this of these gross exports that measure trade in intermediates. So we actually measure the components of these gross exports which are related to intermediate goods, since we know that this value added actually is crosses at least two national borders. So these two components are foreign value added. Okay, so this is part of the gross exports that the borrowing countries take from other countries, and this is a measure of downstream participation to global value chains. Why is that? Because we know that the production in this case starts in other countries, in foreign countries. So borrowing countries in this case are placed in a downstream position, okay, along the global value chain. The other component is this indirect value added, which is part of the domestic value added that is used by importers to build further goods that are then re-exported. So actually, it is used. It is part of the value added of borrowing countries that is used by third countries' exports. So this is a measure of upstream participation to global value chain, because we know that this value added will be used by other countries to be processed, and to build further goods will be then re-exported to other countries. So the first indicator actually is, as I said, is a GVC participation. It is just the sum of these two components. The second indicator is just the logarithmic ratio between the upstream component and the downstream component. This is an indicator that I call GVC position, and is very important in the literature, since the more you are upstream, the more normally you are related. Your participation to GVCs is related to higher value-added activities, since the downstream stages of production normally are just assembling stages of production. So normally lower value-added activities. So these are the main results I get from my econometric exercise. In the first stage, I compare the effect of Chinese loans and World Bank loans on the growth rates of both GVC participation and GVC position. And I compare, and I find that Chinese loans on average can significantly increase GVC participation of borrowing countries. This effect becomes statistically significant 2 years after the loan, and becomes larger and larger in magnitude over years. In terms of magnitude, I observed that on average, 1% loan means 0.40% GVC participation more 4 years after the loan. However, I observed that Chinese loans do not have any significant impact on borrowing countries' GVC position. On the contrary, World Bank loans have a significant impact on African countries' GVC position. They can make borrowing countries more upstream along global value chains. Also, in this case, the effect becomes more significant and larger in magnitude after a while. And however, World Bank loans do not have any impact, significant impact on GVC participation. So I explain this result mainly by the different sector composition of Chinese and World Bank loans. Particularly, as I said, 60% of Chinese loans go to infrastructures, and particularly to transport and communication, while 40% of World Bank loans go to social infrastructure, so social sectors. So why this sector composition is important? Because transport and communications are very strongly related, according to the literature, to trade costs, and particularly to the cost of trading intermediate goods. So this kind of loans can really actually reduce this kind of cost and help countries to participate to trade intermediates with foreign partners. Social sectors, on the other side, are more important to advance human capital capabilities, and then also to advance countries towards upper stages in the global value chain. So the second part of my econometric exercise focuses on Chinese lending to infrastructure sectors, and in fact I find that these loans have a significant impact on GVC participation of borrowing countries, but no effect on GVC position. Then I split the sample into type of infrastructure, and I find that the latter result is driven by loans to transport and communication sectors, as expected, for the reason that I have just mentioned. And furthermore, additional benefits are also seem to be related to concessional loans, which are loans granted at a below market rate, mainly by Exim Bank and MOFCOM. So my policy implications are the following. First, international lending can help African countries to participate, to boost the participation in GVC position, and eventually also to upgrade along global value chains. However, attracting this kind of loans should be seen as a middle-long run strategy, as long as the effects are seen after a while, become stronger by years. Loans to transport and communication sectors are very important, as I said, to reduce trade costs and to help countries to trade more intermediate goods with foreign countries. And additional benefits, as I just said, come from loans of concessional type, which are granted at a below market rate. Thank you for attending, and thank you for the comments you will want to give me.
Thank you so much, Vito. Our third speaker today is Jonathan Munemo. He is Associate Professor at the Department of Economics and Finance in Salisbury University, not far from Washington, D.C. Jonathan is an applied econometrician whose primary areas of interest include international trade, development finance, business regulations, and entrepreneurship. Jonathan's paper today is on Chinese infrastructure loans and whether or not they promote entrepreneurship in African countries. Thank you. Jonathan, go ahead.
Thanks very much, Yoon, and thank you for inviting me to be part of this panel. So the title of my presentation is "Do Chinese Infrastructure Loans Promote Entrepreneurship in African Countries?" So yes, just the outline of the presentation. So there are 5 main parts. The first is the introduction, where basically I'm going to start off by describing, the rising Chinese loans, just to motivate the issues that I'm going to talk about. Then I'll talk about the objectives and then the conceptual framework that I know underpins this objective. And then briefly summarize the key findings and the contribution. Then part B, talks more about the data and the empirical strategy, followed then in part C, where I look at the main findings. Then part D, basically discuss the conclusions and finally end with the policy recommendations. Okay, so let's get started. So figure 1 here displays, China's average loans, to Africa. And 2 things are clear, right? So the first is that Chinese loans have been on an upward trajectory for more than a decade. The second point here is that infrastructure loans in particular account for a significant share of Chinese lending to Africa. And so basically, there are some serious questions really about the economic consequences, that this large scale borrowing from China is having on African countries. Now, my focus, the focus of my paper is on the impact that infrastructure loans have on entrepreneurship in the form of new business startups. So why does this matter? Why does the focus on infrastructure loans matters? Obviously, from the graph, the share of infrastructure loans is quite huge. So that on its own, means that it matters. But there are also some other reasons that I want to discuss. And maybe to provide some context, let me just focus on Dar es Salaam, where we see that disruption of economic activity from frequent power outages and unreliable transport has left businesses with no choice but to invest in costly diesel generators, keep expensive backup inventories, and adopt other coping measures at a significant cost, which is especially relevant for new startups who may be unable to adapt to expensive generators and other challenging coping mechanisms. Also, costly and unreliable power networks increase initial input costs or investments, if you like, that are required to start a business. Unfortunately, however, infrastructure deficits like the ones that we see in Dar es Salaam are not just unique to Dar es Salaam. They are quite prevalent in many large African cities. So if you go to Dakar in Senegal, it's the same story. If you go to Kampala, right, Uganda, same story. If you go to Harare, in Zimbabwe, it's a similar situation. In fact, according to the World Bank Investment Climate Surveys, African firms have consistently ranked economic infrastructure deficits as an important constraint for doing business. So, a good infrastructure, on the other hand, enables opportunities by connecting firms to their customers and suppliers, also by helping them to take advantage of modern production techniques. To give an example, efficient transport infrastructure links create opportunities for firms to buy and sell, not just domestically, right, but also in global markets. And this is very, very important for Africa, where poor infrastructure has been found to account for a large share or a percent of the cost of transport. And this cost is significantly much higher, for the landlocked countries. So from this discussion that we've had so far, I think you can start to visualize sort of the conceptual linkages, right, through which we may expect, infrastructure loans from China to impact entrepreneurship. And so here's a summary of the conceptual model. So we can start from the bottom here, right, with the Chinese loans that are coming to Africa. We expect that, this will increase, economic infrastructure, roads, rail, ports, airports, and so forth, which in turn creates opportunity, enablement, and lowers firm entry costs, as we've just discussed, thus leading to a better business environment, which in turn would then lead to new firms entering into the domestic economy, which is what we call new startup entrepreneurship. So, so conceptually, right, this is how we expect Chinese loans, this is the causal mechanism through which, infrastructure loans impact entrepreneurship. Okay. So is there support for this conceptual mechanism? Well, the headline news is yes, there is support. In fact, the paper finds robust evidence that African countries with a higher percentage of economic infrastructure loans in GDP have greater entrepreneurship in the form of new business startups. To be more specific, I find that increasing total economic infrastructure loans by 1% is on average associated with a 3.6% increase in new business startups. So basically, this finding basically supports this conceptual view that large-scale investments in economic infrastructure, such as roads, ports, electricity grids, telecommunication networks, create business opportunities and reduce doing business costs, not just in Dar es Salaam, elsewhere in Africa as well, right? Through that conceptual mechanism that I discussed in the previous slide. And so contribution to the literature here is that, there's no comparable research that is focused on China's lending activities in Africa, which as we've seen has expanded, right, in recent decades. The relatively small recent literature is focused mainly on the determinants of Chinese financing to Africa, as well as debt sustainability implications for African countries. And so basically using the database of Chinese lending to Africa that was recently assembled by SAIS CARI, this paper complements this existing literature by analyzing how China's economic infrastructure loans affect entrepreneurship in Africa. So now let me come to the empirical model and the data. So essentially, I estimate panel data regressions where the dependent variable is basically the log of new business startups, where new business startups measured by new business density, which is the number of newly registered firms per 1,000 working age population. Then on the right-hand side of this equation, loan basically is the total economic infrastructure loans as a percent of GDP. Then I have some control variables here, basically to capture, to control for the domestic constraints that the literature has shown to be important. So this includes, institutional quality. There are 6 indicators of institutional quality that I use. I also control for the quality of the business regulations using the number of startup procedures to register business. I also control for access to credit, basically as measured by domestic credit to the private sector. And then I also control for the level of development using GDP per capita. So the key findings are as follows. The first one I've already explained, the headline news is that, economic infrastructure loans do in fact increase new business startup activity. But also in addition to that, I find that new firm creation is significantly lower in African countries that have greater regulation-driven barriers to entry. To be more specific, increasing entry regulation for firms by one procedure significantly curtails new business formation by about 8.1%. And also the other factor is poor institutional quality, where I find that a one standard deviation improvement in institutional quality significantly raises new business density creation by 77%. And then also the other result, is that it relates to restricted access to private sector credit, where basically expanding access to private sector credit by just 1% significantly raises new business activity by about 2.3%. So these are the key findings. And so these conclusions really are consistent with the conceptual view that Chinese economic infrastructure loans do promote new firm startups by creating new business opportunities and by reducing infrastructure-related costs. And so this result is important from a development perspective, right? Because the contribution of new startups to development is undisputed, their significance. So basically, new firm creation is credited for boosting the overall productivity and economic growth of a country through its positive effects on efficiency and innovation. In addition, newly established firms also contribute significantly to job creation. So the results are quite significant, from a development perspective in that regard. Now, so 3 main policy recommendations emerge from the study. The first one is that to promote new business startups, African nations should, with limited fiscal space, should use loans from China, prioritizing business creation opportunities and reducing the costs of doing business. And here, 2 key points are important. The first is that the loans should target financing all 3 types of economic infrastructure, that is transport, communication, and energy. I mean, this is crucial because these infrastructures complement each other, all right? They interact. So for example, transport costs that are caused by poor infrastructure are affected by other types of infrastructure, including the extent to which telecommunication systems allow firms to track their goods in transit, and how quickly goods can be cleared, through customs for those firms that are engaged in international trade. Secondly, the focus should be on improving both access and reliability of infrastructure services, right? I mean, it doesn't help at all to be connected to an electricity grid if there's no power supply. So yeah, so both access and reliability do matter. So the second policy recommendation is that provide access to private sector financing. So in World Bank investment climate surveys, African firms cite access to finance as their second biggest operating constraint after poor infrastructure. The African Development Bank also notes that startups in particular are subject to more credit constraints. And then the third policy recommendation is to strengthen the regulatory and institutional framework to create a more conducive business environment. So in other words, tackle unfavorable business regulations through entry deregulation, and then also address poor quality institutions by combating corruption and strengthening the rule of law. I'm emphasizing corruption and rule of law because in my results, these were the most significant. So in other words, develop what are known as inclusive economic institutions. So if we draw from new institutional economics theory, inclusive economic institutions basically promote development outcomes by providing a higher degree of business or market freedom and stronger protection of private property. And so essentially, inclusive institutions is really what matters here. And according to the African Development Bank, the harmful consequences are related to regulatory and institutional constraints, often fall disproportionately on new entrepreneurs. Thank you very much. I look forward to your comments and suggestions.
Jonathan, thank you so much. Our last presenter today is Marvelous Ngundu. Marvelous recently received his PhD in economics from the University of Johannesburg in South Africa. He also holds degrees in financial economics from the Great Zimbabwe University in Zimbabwe, and a BCom in banking and finance also from Zimbabwe. His paper is going to focus on how economic growth in Africa responds to Chinese loans. Marvelous, over to you.
Thank you, Prof. Thank you, Prof. Yoon, for the introduction. This presentation is based on my paper titled How Economic Growth in Africa Respond to Chinese Loans, using empirical evidence from CARI's dataset. The main aim is to contribute to the debate on the sustainability of Chinese loans in Africa. And in contributing to this debate, and for this presentation in particular, I'm going to cover three major issues: what CARI data can tell, the economics of external debt financing in the West economy, and the empirical analysis of debt dynamic related indicators. Looking at this graph here, it's undisputable that there has been a surge of Chinese loans in Africa, from less than $1 billion in 2000 to approximately 29 billion in 2016. Even though in 2017 and 2018 it has increased, but the dramatic increase is quite remarkable. So given the default history of African countries when it comes to external debt, this surge has sparked debate on the sustainability of Chinese loans in Africa. On one end, some analysts are of the view that China is pursuing its geopolitical agenda by trapping African countries into unsustainable loan. On the other end, some analysts are quite optimistic that Chinese loans can contribute to growth and development in Africa. And they are based on the fact that the Chinese loans, most of the Chinese loans are provisioned for hard infrastructure, unlike the traditional creditors, which focused precisely on social economic development projects, as Vito has just alluded. So looking on the distribution of Chinese loans in Africa, CARI dataset shows that Chinese loans are concentrated in few African countries. And the big five recipient of Chinese loans African countries, number one, it's Angola, as you can see here. Number two, it's Ethiopia. Number three, it's Kenya. Number four is Zambia. And number five is Sudan. And this analysis is based on Chinese loans data to African countries for the period 2000 to 2018. And in terms of sectorial distribution, it is actually true that quite significant portion of Chinese loan is provisioned for infrastructure projects, precisely transport, and energy, and also communication. It is only in Angola where quite significant amounts of Chinese loans are provisioned for mining. And there has been case studies that have been presented in this forum, focusing specifically on Angola and why Angola has received such considerable amount in mining sector. Right. What does literature say about external debt provisioned for infrastructure? there is a substantial literature justification that optimal levels of external debt provisioned for productive sectors like infrastructure development projects provide growth opportunities precisely for developing countries like in Africa. The notion is that productive sectors generate enough returns to make loan repayments, to invest, and to invest even in other growth enhancing projects. So this is the basic concept. This is the underlying concept why some of the analysts are quite optimistic that there is a possibility of Chinese loans contributing to growth and development in Africa. But however, for assessing debt sustainability in an economy, some studies argue that it is not adequate to rely solely on what data can tell and on what literature can tell. It is actually sufficient that one has to conduct an empirical investigation based on debt dynamic related indicators. And it's by no doubt that any debt related indicators that can bring hope to the economy, it's economic growth. My empirical strategy is adopted from the exogenous growth models, where aggregate output is explained by physical capital, technical progress, and labor. These models, these growth models, argue that the major determinant of growth in an economy is capital accumulation. However, capital accumulation can only explain growth in the short run. In the long run, there should be a productivity parameter that has to be added in the production function for growth to continue. So as studies keep on investing what could be the growth parameter which can help sustain growth in the long run, most of the studies agree that policy-oriented variables, for instance, trade openness, institutional quality, government expenditure, technology, and other exogenous variables that the model cannot explicitly account for. For this case in particular, there is an argument that Chinese loans are provisioned mostly for the constructive projects to provide work opportunities for Chinese contractors. This can be regarded as an agent for technology and brain drain spillovers. So it can be regarded as an exogenous technical progress that the model cannot explicitly account for. In terms of how Chinese loans were incorporated into the model, I regarded Chinese loans as an additional capital in the production function of the African country, such that my model accounts for the domestic capital and also for Chinese loans as the foreign capital. Then in terms of my productivity parameter, I chose trade competitiveness based on one major reason. If Chinese loans are provisioned for infrastructure projects, energy, communication, and transport, what it means is that in the long run, energy enhances production. And the assumption is that as production increases, there is surplus, and that surplus might be tailored for the export market. Then transport and communication increase access and networking in trade. That's efficiency. So in the long run, given the fact that Chinese loans are provisioned for infrastructure development, we expect trade competitiveness to boost in Africa. Hence, my productivity parameter will take in the form of trade competitiveness. Equation 2 can be deduced into a linear panel data model in the following form, where changes in output level can be explained by the initial output level and the regressors. These regressors include both capital accumulation, variables, and also productivity parameter. Then this equation, equation number 3, can be deduced into equation number 4. It is not by choice that if you are following exogenous growth theories, output or economic growth is measured in output levels. It's actually how the model is decomposed. Then my model will be was estimated using the GMM Panova framework. Besides the fact that this framework accounts for individual country heterogeneity, it is also insightful because it goes beyond just the explanation or the interpretation of coefficients, but it reveals the adjustments and the resilience of African growth to Chinese loans. So the steps that I took, first I estimated a model without a productivity parameter, which is trade competitiveness, to find out if Chinese loans can contribute to capital accumulation in Africa in the short run. Then the second estimation that I did, I then added trade competitiveness to find the long run effect of Chinese loans in the African growth. This is what I found out. And my results are consistent to the exogenous growth models. What we found out is that the impact of Chinese loans on Africa, on Africa's growth, is transitory. Africa's growth responds positively to Chinese loans only for a short period of 5 years. That's when it is positive. Then after 5 years, the effects of shocks to Chinese loans on growth in Africa phases out. And this is due to lack of productivity. This is due to lack of productivity. The empirical findings above indicate that Chinese debt financing in Africa does contribute to physical capital accumulation. But for growth to continue in the long run, there is need for African countries to improve on their productivity capacity. And from what CARI data can depict, it can be concluded that Chinese loans bear less risk of dragging African countries into debt crisis because a large portion of it is provisioned for infrastructure projects. Then in terms of policy recommendations, there is lack of accountability of Chinese loans in Africa. It remains Africa's countries' responsibility to ensure that Chinese loans are effectively invested in the provisioned infrastructure projects to generate both productivity enhancing economic benefits and enough returns to make repayments. Other key productive sectors that can be tapped using Chinese loans include manufacturing, mining, and agriculture. And this initiative should be complemented by reforming institutions involved in acquiring and servicing of Chinese loans. Otherwise, successful negotiations of possible lower repayment rates and new compatible repayment plans can add as a bonus. I thank you so much.
Thank you, Marvelous, so much. Before I introduce the discussant, I just wanted to remind everyone again that the Q&As are open. You can type in your questions at any time. Please go ahead and do that, and we'll take up as many of them as we can at the end. I'm very, very pleased that we have as our discussant today, Hervé Lado. He is an economist with a focus on political economy. He currently serves as the Guinea country manager for Natural Resource Governance Institute, or NRGI, which is a New York-based nonprofit policy institute that works with governments and civil societies to promote a responsible management of extractive resources. He has actually done field research on oil companies' contributions to sustainable development in Nigeria. He's also worked on a hydropower plant project in Cameroon to provide technical assistance on social impacts. He is very well qualified to comment on these papers, and everybody welcome. Thank you for joining us.
Thank you, Yoon. And I thank the SAIS CARI for associating to this event the Natural Resource Governance Institute that I represent in Guinea. And CARI's database has well supported our energized global report on resource-backed loans last year, 2020, which is now opening new perspectives in our work in Africa. I also thank all speakers for their research and their very clear and informative presentations. I will not claim to cover all the wealth of their papers. My questioning will turn around the China specificity in their findings. Let me start with Keyi. Your research is important because it addresses the challenging issue of how to reach with the development finance the people who really need it and need it the most. And with your research, we reach some interesting insights and findings looking at China and the World Bank. But let me question a possible bias in the approach, in the comparison. What is the China specificity here among bilateral partners beyond the nevertheless valid usual point on little conditionalities from China? Because comparing a multilateral to a bilateral partner, while conversely to multilateral partners, many bilaterals may face common issues of limited means for the enforcement of the rules and conditionalities on the ground, and this can bring a bias in understanding the China specificity. But with your first finding, which is that democracy may facilitate clientelism under weak institutions, with this finding, you join clearly a burning debate which has been shaking the continent about the relevance and rewards of democracy versus autocracy. A debate that usually showcases China as a successful non-democratic model. So your inference that autocracies might be wiser in aid redistribution than so-called democratic regimes is really striking, though it is not new. But a question would be: would the political competition promoted in Africa be a key impediment of aid redistribution in the African context? Turning now to Vito. Thank you for your presentation. It explores the extent to which China and World Bank lending support Africa countries in the industrialization path. Your research is important and useful because industrialization is at this stage seen by many actors, including African institutions, the African Union, the African Development Banks, and others, as the missing fundamental reform in many African countries. So you find that Chinese lending enhances the intensity of global value chain participation because of its high infrastructure content, while World Bank lending is related to an upgrade in value addition of African countries along global value chains because of the services content and social content of World Bank lending. Again, here, regarding the specificity of China in these findings, if any other donor increases loans infrastructure content to the same level as China, will we get the same rise in intensity of global value chain participation? Is there any other parameter in the Chinese approach that explain the difference we can see with other lenders. If Chinese loans impact is due to the infrastructure content as you suggest, is there any level of infrastructure content of loans to reach by a donor to impact the global value chain participation in African countries? Turning now to Jonathan, you are exploring the impact of Chinese loans on African economies, especially on entrepreneurship. The originality of your paper is the connection you build between China loans and entrepreneurship in Africa through economic infrastructure. It's not that obvious, and this is really great. You find that African countries with a higher percentage of economic infrastructure loans have greater entrepreneurship in the form of new business startups. Again, here, is there any China specificity in the funding, apart from China being an infrastructure-focused donor? Is this a donor-blind finding? If any other donor increases the level of loans and the loans infrastructure content to the same levels as China, would we get the same impact on entrepreneurship? Is there any threshold of the infrastructure content of loans or of the share of loans in the recipient's GDP to reach that will enable such an impact on entrepreneurship? Now, Marvelous has explored the dynamic relation between Africa's growth and Chinese loans. There have been little studies on this kind of impact, and it is great that the new CARI's database makes it possible. Marvelous, your second finding on the irrelevance of economic growth, the irrelevance for economic growth of Chinese loans in the long run, and the relevance of investing rather in productive sectors, in more productive sectors, is striking and deserves more investigations. It sounds quite contradictory to other speakers' findings we've heard before, though they were not testing the same parameter, which for you is economic growth. My question is, have you tested, I may have missed it, but have you tested the impact of Chinese loans on productive sectors in the short run and found it higher than their contribution to physical capital accumulation? If Chinese loans can boost growth in the short run and not the long run, shouldn't this rather suggest that for the long run, borrowers should mobilize other funding sources, either domestic or from other donors, or from China, but with less infrastructure content, to sustain the growth momentum enabled by the capital accumulation? Thank you for your attention. I will stop there.
Thank you, Hervé, for your questions. So I would like to read out a few of the questions that came through on the Q&A, and then we'll do a first round going back in the order of the presentations. I'll ask all of the speakers to turn their cameras back on, and if we can go back in order, then you guys can start taking up the questions. Just give me a second while I pull up the questions again. Okay, so in addition to responding to Hervé's comments and answering his questions, we have a few questions that were not specifically addressed to any of the panelists. Emmett Stinson, an intern at the US State Department, asks, when Chinese infrastructure projects contract Chinese labor for construction, does this undermine the economic boost that infrastructure investment is supposed to bring to Africa through lending? There was a related question from Azania Trade. What is the rate of local startup hire versus hiring of Chinese firms who are awarded contracts for infrastructure development? I think perhaps Jonathan is best positioned to answer those questions. But if anyone else wants to comment, please feel free. Adrian Chikowore from the policy, a policy and research consultant from the International Public Finance at the African Forum and Network on Debt and Development, AFRIDED, in Harare, commented that they were particularly worried by the comparison of the World Bank versus China. I'm assuming this is for Keyi. And he asks, wasn't there any way of comparing the World Bank with China Exim Bank or the China Development Bank, as biases may be problematic? And then we have a question from William Bennett Lynch, who says that he's currently writing his dissertation on the topic of transport development projects in Kenya, Tanzania, and Mozambique. He was wondering what you think of the insurgence of infrastructure will impact Africa in the long run. And finally, for Vito, there's a question from Mohammed Sidebe, who says that asks about investment, China's investment in the mining sector compared to the World Bank's. And from his analysis, are the loans, which loans are more important? Okay, so if we can take those questions as a first round, and again, go in order of the speakers. So let's have Keyi first.
Thank you, Yoon, and thank you, Ahway, for your great comments, and for the attendees to tolerate our talking a lot. So yeah, I definitely agree with what you said about, I think this speaks to Adrian's question too, of the multilateral and bilateral comparison. I think one thing shocking I knew was that in the continent, the World Bank has like 10,000 or 20,000 staffs. Well, I knew from gossip that Chinese Exim Bank may only have like less than 100 people on the ground. Or I mean, just doing check. Yeah, in that sense, it definitely is going to be harder for the bilateral to keep that enforcement and checking how the projects are going on. I guess in these research things, the multilateral, bilateral is fading as my comparative like objects is more on the different African countries, on their state and society synergy. So in that sense, whether China or the World Bank, I mean, despite of their different identity as multilateral or bilateral lenders, you know, their result seems to be similar in terms of the ethnic favoritism. And the second question that Ahway pointed out is that, of course, I'm not going to endorse autocracy. This continent has experienced too many crazy autocrats. I guess this speaks to what Van der Waal has said about the Africans' democracy fatigue, where we have a lot of, you know, newly rising multi-party politics, but they're not necessarily having the necessary institutions supporting that. So what I would say that here is that we should, you know, in making sure that the money reaches the people who need them, we need to build the institution first, not looking at, you know, just the score of the democracy level. Yeah, that's all.
Thanks, Keyi. Vito.
Yes, I thank Harvey for his very useful comments. Of course, as I say in the conclusions of the paper, I'd like to you know, exploit some eventually to some case studies to go deeper in some of the potential in some points about the mechanism that about the specificity of Chinese lending. My research work is works on gives some results on average about 35 countries. I know that all the countries in the sample have received at least one loan in infrastructure infrastructural sectors. We know that these loans are normally of very big size. And of course, so it seems really that they can impact trade in intermediates. Nevertheless, of course, perhaps some cases it would be very, I think, very useful to explain some, further dimensions that you mentioned. World Bank actually has the role of World Bank lending for the same sectors is less extensive. So that means that not all the countries I deal with in my sample have received the same loans in this sector. So actually, there's no way actually at the moment to have direct comparison between these two lenders in these specific sectors, given that the different relevance that these sectors have for the two lenders. About the second, the other question about the relevance of mining sector for China. Well, of course, mining is very important, but only in a few countries. While all the countries, as I said, in the sample have received at least one big, say, loan in infrastructures, there are many countries in the sample that have not received any loan in mining. So mostly of the investment of the loans to mining go to Angola, actually, and Niger as well, Namibia and Kenya as well. Most of the countries have like zero loans in those sectors. So I would say that they are not, at least for the results I got, they are not super relevant, at least in terms of access to JVCs. Okay, thank you.
Thank you very much for the questions. Let me start with the questions that were raised by the discussant, which are very good questions, by the way. So the first question was, is this a donor blind effect, this idea that, the infrastructure loans are, boost, new local firms? Well, intuitively, right, and also looking at the conceptual framework, right, the causal mechanism, as to how infrastructure loans, eventually impact, new firms. I would say, yeah, it doesn't matter, right, where the source of the funding is coming from. As long as you boost, infrastructure, spending, and then through that transmission mechanism that I described, we should see basically new firms being stimulated. And and also, if you look at Africa, right, the infrastructure deficits are huge. So if you look at surveys that are conducted, by the World Bank, most firms cite that, electricity in particular is a huge problem. And you saw with the example that I gave in Dar es Salaam, but it's also many other countries. Electricity, is a huge problem. Then followed by transport, right? That's the other, huge, infrastructure problems that countries have. So the deficits are huge. The financing requirements are large. So I would say, it would be good, if more donors, right, can come on board, and help close this deficit. And then the second question, is there a threshold effect? In other words, is there a minimum amount of infrastructure finance that is required, to boost entrepreneurship? I think that's a very, very good question. And I think it's an empirical question that is worth exploring, because for policy purposes, I think it matters, right? For governments to know if there's a minimum amount that they should be targeting in order to have some economic benefits, which would include boosting entrepreneurship. So thanks for that. I would certainly explore it as extensions to what I've done. So thank you for that comment. And then the other comment that came from the Q&A that Yoon also gave to me was, I think the question was looking at the employment effects of comparing the employment effects of Chinese firms in Africa versus the startups that are stimulated by Chinese loans. It's an interesting question. It's an interesting question, and and the answer is an empirical question. It needs to be investigated because potentially when I think about it, there are two possible effects. There could be a crowding out effect where basically Chinese firms basically are displacing local firms, employing all the locals, and sort of discouraging from starting their own enterprises. Or there could be a complementary effect, right, where through some linkages, Chinese firms actually help to boost local firms. So it's an empirical question that that can be investigated. Maybe if CARI gives me another grant next year to go to Africa, I wouldn't mind looking into that. Thank you.
Hi, marvelous.
Thank you, Prof. I did conducted a research that I wrote another paper which focused precisely on the loans meant for infrastructure, transport, energy, and communication. And I got the same results, that Chinese loans as a capital input in Africa, they have a short-run impact on growth. So these results are actually consistent to the literature if we are following the exogenous growth models. Africa is on the mercy of loans all the time, external debt, because of lack of capital. But if this capital is availed in form of loans, it has to be utilized productively so that in the long run, they can actually generate their own capital accumulation using domestic investment. So I'm not quite surprised, or my results are not quite odd from the literature, especially based on the models that I was following. Chinese loans as the capital accumulation has to be utilized effectively towards the productive sectors, such that in the long run, we won't depend more on the external debt, but Africa can actually be able to generate its own capital internally.
Thanks, marvelous. Are you finished, or was there more?
I'm finished, unless if I wasn't clear.
No, that's fine. Thank you. Hervé, I was gonna just go back to you and ask if you had anything else that you wanted to add.
Let me give Marvelous the opportunity to answer maybe the second question about let me come back about the policy implications of his findings. Did I get you well in understanding that the recommendation would be let's tell China to fund more productive sectors rather than infrastructure? Or are you saying that with Chinese loans, we can fund, African countries can fund infrastructure accumulation and then bring domestic source to funding for more infrastructure or for more productive sectors? Because it looks like you are rejecting the importance of funding infrastructure with Chinese loans because it's not enough, let's say, rewarding rather than funding more productive sectors. Just to be clear on what are your policy recommendations?
Okay, thank you. My findings are not rejecting infrastructure. In fact, infrastructure projects are part and parcel of productive sectors. My policy implication is especially precisely on infrastructure projects. I'm saying Africa has to be accountable. They have to effectively utilize the Chinese loans provision for infrastructure projects so that they can enhance or they can stimulate higher returns, number one, for repayment, number two, for reinvestment, number three, for investing in other growth enhancing projects. I'm actually, my results are actually quite supporting and are actually pro to Chinese loans. The fact that they are provisioned for infrastructure projects, it's a benefit to Africa. But in the long run, we can't be relying on Chinese loans to keep on improving our infrastructure. Our infrastructure has to be improved to a certain point where we can be able to generate productivity ourselves, domestic investment ourselves, to even invest in other growth enhancing projects like in manufacturing, mining, agriculture, etc., etc.
Okay, I get it
know
clear now. I think it was not that clear in my reading, first reading of your paper, but it's okay.
Oh, thank you.
Thank you, Hervé and Marvelous. We just have a few more questions, and I think given that we have about 3 minutes left, we can probably get through them. For Jonathan, Seth Miller writes, given that most businesses in Africa are informal, did your study factor informal new businesses that come up due to PRC infrastructure development? And then Edwin Lee asks, is there a comparison between Chinese ECA and other countries' ECA on its funding Africa, such as sectors, countries, size, rate, etc.? And then Edwin also asks Marvelous specifically, who decides how the Chinese loans will be used or invested into which sector, the African country or China or both? And then finally, we have a comment from Azania Trade again, saying, I suggest someone receive a grant to report on the competitive or complementary nature of Chinese firms versus local business startups in Africa. This will provide insight into productivity and effective growth. Okay, thanks, Azania. Okay, Jonathan, and then Marvelous, and then I think we can wrap up unless anybody else has anything to say. Please just unmute yourself.
Thank you very much for that question, which is a very, very important question. Because you are definitely right. The share of informal enterprises in Africa is huge. It's an important component of entrepreneurship. And we have to account for it. But unfortunately, due to data constraints, I could not cover the informal sector. I would love to cover the informal sector. Again, if CARI can give me a grant to do this, and build on what I have, yeah, I think that would be a very, very important thing to do. Thank you.
Marvelous, did you have any final words?
Regarding the question that has been posted, it's debatable, Prof, and to the attendants, it's debatable who really decides which sector should be provisioned for Chinese loans. And perhaps it might be, I suggest it as a further area of research, which I doubt if there could be a solid findings that can come out of it. But it's really debatable. I'm not in a good position to answer whether it's African countries or it's China.
And maybe I just give a final opportunity to Keyi or Vito if you have anything else to add, something you didn't get a chance to say, just very briefly. With that, I want to thank everyone for joining us today for this last session of the CARI 2021 conference. Given the highly controversial nature of everything that is China-Africa, for those of us who've been researching in this field for a long time, we know that how fraught it can be. I think that the kind of research that CARI has been able to support is really important in bringing empirical evidence to bear on the questions at hand. And this kind of comparative work, right? Examining Chinese lending practices in multiple countries around the globe, examining Chinese lending practices as compared to other financial financing countries and institutions, comparing the activities of Chinese actors, both lenders as well as state-owned enterprises and private sector companies across African countries. All of these types of kind of comparative and empirical research is incredibly important to understanding not just the range of impacts, but how these various actors operate and how they compare to one another. It's only with this kind of empirical evidence that we can really understand what's happening. And for that, I thank all of the researchers, not just the ones on today's panel who did a great job, but also all of the participants who have contributed their work throughout the CARI conference. And just a final word of thanks to Marie Foster and the SAIS IT team for making all of this possible, and to the generous funding from the Carnegie Corporation of New York, who were actually covered the research funded for the last two panels of our research fellows. Thank you very much. Recordings for this event and for all of the others, and many of the papers that were presented are available or will soon be available on the CARI website. So again, thank you everyone for your participation, and we will hopefully continue this work. Thank you again.
Thank you.
Thanks, Yoon.
Thank you,
Take care,
everyone.
everybody.